What happens when a crypto ecosystem turns off its rewards engine, disables its VIP incentives, and hands control entirely over to its users? That's the question no one seems ready to answer. But it's the one the AFX community needs to ask. Right now, as AFX trades at $0.1173, the broader market is only beginning to understand what this token represents. For months, investors watched the platform roll out Aifeex integration, strip away legacy systems, and unlock staking rewards over a controlled 100-day cycle. But here's the twist. Once that timer hits zero, no more staking rewards will ever be created. None. This isn't just a policy change. It's a structural finality. And in crypto, finality like that, especially around token emissions, doesn't just change behavior. It changes everything. Let's rewind a moment. AFX was always more than just another altcoin with AI branding. It launched with an ambitious idea to merge decentralized finance with real-time AI tools, all within a transparent and user-governed protocol. In theory, it would evolve into a self-sustaining economy where traders, stackers, and AI signals would harmonize across a cross-chain liquidity network. But like all bold projects, its early days were marked by centralization, onboarding rewards, and complex referral incentives. That worked at first. But then came the shift, the Aifeex dApp launch on September 1st, 2025, and the staking protocol upgrade on September 15th. In those back-to-back announcements, Aifeex drew a line in the sand. From this moment forward, the community would have full control, and the protocol would no longer incentivize user growth with artificial yield. Here's what the upgrade really means in technical terms. First, the old VIP system, which rewarded users for inviting others, is gone. Referral networks are completely wiped. Second, annual staking is canceled. All remaining yield is released over a 100-day schedule, gradually unlocking both principal and rewards at fixed intervals. And finally, once those 30 million AFX tokens are fully distributed, the tap shuts off. No new AFX is created. No new staking pools appear. It becomes, in effect, a closed-loop asset. This is what's known in macroeconomic models as a supply terminal event, a moment when new issuance ends and price discovery must rely entirely on circulating demand. So where are we in that timeline? Well, if you mark the September 15th upgrade as day one of the release cycle, then by late October we're already nearing day 40. That means nearly half of the planned unlocks have already entered the market. But the price? It's still holding steady near 11 cents. And that's fascinating. Because in most projects, large token unlocks, especially from staking yields, trigger immediate price drops. Holders rush to sell. But here, we're not seeing that. Instead, on-chain data shows wallet activity is increasing, not decreasing. Smaller retail wallets are accumulating. Larger wallets, those that previously staked for VIP status, are consolidating, not dumping. That's not what you see in a collapsing project. That's accumulation behavior in the face of tightening supply. And that leads us to the big question. What happens when the 100 days are over? When the last of the 30 million AFX reward tokens are released and the emission schedule shuts off completely, we enter a fundamentally new market structure, one defined by scarcity, autonomy, and behavioral shifts. Let's break this down. In traditional crypto models, staking rewards act like inflation. They introduce new tokens into the system over time, diluting supply and encouraging participation. That's fine, as long as demand outpaces issuance. But it creates a long-term problem. Once user growth slows, the inflationary pressure catches up. That's how countless protocols have collapsed, by over-rewarding early users at the cost of long-term sustainability. Aifeex, in contrast, has made the controversial decision to end that cycle entirely. And in doing so, they're introducing an entirely different incentive model, one where future value isn't extracted from new issuance, but created through protocol utility. In other words, the only way to grow from here is for the actual product, the AI tools, the DeFi integrations, the analytics dashboards, to deliver real value. That's risky, but powerful. Because if the tools work and users engage, there's no inflation dragging the token down. Every increase in demand translates directly to price pressure. And that's exactly what some whales are betting on. Let's look at some wallet behavior. Recent data from AFX's dApp shows that several of the largest wallets, those previously tied to VIP status, are now staking through the weekly cycle only. That's significant. It means they're preparing for a low liquidity environment where fast cycles and flexible access matter more than passive accumulation. It also means they're not expecting a mass exodus. If they were, they'd be withdrawing completely. But they're not. They're shifting tactics, and that's a bullish signal. Because when large stakeholders reposition, they don't do it emotionally. They do it based on internal metrics. And what they're seeing, apparently, is a protocol stabilizing after release. Meanwhile, retail behavior is beginning to change too. Search interest in AFX dApp has climbed steadily over the last 30 days, particularly in regions like Southeast Asia, the UK, and Turkey, all previously strong crypto adoption zones. Telegram groups are growing again, albeit slowly. And the real kicker? Exchange wallets are receiving fewer inbound AFX transfers. That means fewer holders are selling. The pipeline of sell-side pressure is drying up, even as supply continues to release. This is the hallmark of an upcoming supply squeeze. And it's happening right in front of us. Now let's speculate. What if this trend continues? What if, by day 100, the entire unlock is complete, but the market hasn't collapsed? What if demand holds steady, or, even better, begins to grow? That's when price action gets aggressive. Because remember, once the final reward is distributed, the circulating supply becomes fixed. And in crypto, fixed supply is a powerful psychological driver. Think Bitcoin post-halving. Think early Ethereum post-merge. When markets know no more is coming, they begin to revalue what's already out there. And if AFX continues to deliver on its DeFi tools, AI dashboards, and upcoming cross-chain integration, then that revaluation could be significant. But it all hinges on one question. Will the community respond? Let's talk about the human side of this transition. Crypto isn't just code and charts, it's behavior, belief, and timing. And as we approach the end of the AFX 100-day cycle, the psychological pivot becomes just as important as the technical shift. Until now, users were trained to rely on staking rewards. You lock, you wait, you earn. But now, that dynamic changes. Users must evaluate. Why am I here? Am I staking because I believe in the ecosystem, or because I'm chasing short-term rewards? That question divides tourists from settlers. And right now, AFX needs settlers. Fortunately, the architecture encourages that. With VIP rewards disabled, invitation networks dissolved, and all staking unlocked within 100 days, there's no longer any game to play. No manipulation to exploit. The protocol is bare, clean, and that's rare. Most crypto ecosystems drown in complexity. But here, simplicity may be AFX's greatest weapon. Users can see the schedule. They know exactly when the final token drops. There's no mystery, and that transparency builds trust. Now let's look at comparable historical moments. In 2020, the Synthetix protocol underwent a similar reward tapering, reducing its SNX emissions to push towards self-sustainability. What followed was a 9-month period of consolidation, then explosive growth as demand overtook supply. Likewise, in early 2022, Lido faced a supply recalibration after the Ethereum merge, and despite fears, LDO held strong. In both cases, the key was utility. If the product delivers, the token survives the taper. If not, it dies. For AFX, the next few weeks are a testing ground. The tools are live. The staking is winding down. The question is, who will use the system once the rewards are gone? Early signs suggest engagement is growing. Daily active users on the dApp have climbed steadily since October 1st. AI bot queries are increasing, particularly for market trend predictions. And interestingly, more users are exporting their wallet data for off-chain tracking. That means they're treating AFX not just as a speculative asset, but as a platform. And that's where price comes back into focus. If we assume demand holds or grows, and supply finishes unlocking, the conditions are ripe for a supply shock. And that's not just theory. We've seen it before. When emissions end and utility persists, prices move fast. 11 cents may seem low now, but if just 20% of current holders decide to buy back in post-unlock, while supply freezes, we could see a rapid run toward 30 cents, 50 cents, or beyond. It wouldn't even take major exchange listings, just a continuation of current trends under constrained supply. If you followed this far, you're starting to see the full picture. The AFX ecosystem isn't just removing inflation, it's creating a vacuum. A vacuum where the only thing that can fill the gap left by staking rewards is real demand. And that kind of economic structure is brutally honest. There are no shortcuts, no synthetic yields, no gameable incentives, just product, value, and belief. And if AFX survives that pressure, or better yet, thrives in it, then we could be looking at one of the most impressive post-reward cycles in recent crypto history. Let's zoom out one last time. The current AFX price is hovering around $0.1173. Daily trading volume is moderate but stable. Wallet activity is rising. Sell pressure is drying up. The final staking rewards will run out within the next 60 days. And no more rewards will ever be issued. That means from here on out, the only way to earn in this ecosystem is through participation, using the tools, trading through the platform, engaging with the AI. And if that happens, we shift from a tokenomics-led economy to a utility-led one. That's where things get real. The community, too, is evolving. Old referral-based hierarchies are gone. Power is diffusing. Telegram admins are no longer the loudest voices. Developers and ecosystem builders are rising instead. And while it may feel quieter, it's also more authentic. Users are asking sharper questions, demanding real timelines, and, for the first time, using the platform instead of just farming it. That matters. Because in crypto, true strength isn't built in hype cycles. It's built in the quiet before the storm. And speaking of storms, the market isn't going to stay quiet forever. As we enter Q4 of 2025, broader crypto sentiment is turning. Bitcoin is flirting with another leg up. Altcoins are waking up, and retail attention is creeping back in. If AFX can position itself as a utility-first, AI-integrated, supply-constrained platform during that macro rotation, the results could be explosive. And not just in theory. On-chain models show that if current accumulation continues, and just one tier, one exchange lists AFX during the post-unlock window, a 3x to 5x price movement is not only possible, it's statistically reasonable based on comparable ecosystems. But that's the future. For now, the mission is simple: Survive the cycle. Prove the tools work. Let the last rewards unlock. Watch the market respond. Because when that day 100 timer hits zero and the faucet closes for good, the game changes. And in that new game, only protocols with real utility, real users, and real scarcity will win. So if you're holding AFX right now or considering entering the ecosystem, ask yourself one final question. What happens when there's nothing left to earn, except through usage? If your answer is still bullish, then you might just understand what comes after 11 cents. And if you've made it to the end of this deep dive, do yourself a favor. Subscribe to the channel for more expert crypto journalism, in-depth breakdowns, and real-time market narratives like this. We're just getting started.